Hey folks, welcome back to episode 14 ICT 2024 Mentorship. It's gonna be a long video, so I don't want to waste time over here. Just remember to give me the thumbs up and subscribe to my channel if you are new. Let's start the video. Over here, this is the daily chart for Mini Nasdaq, and all you can see this is that volume imbalance in that yellow box. Okay, and over here, this is the sell side imbalance, buy side inefficiency high. Over here I have marked the rejection block. Now if you look over here, this is the set. If you toggle that set, you will see the gap has changed, the volume balance has changed. Okay, most of the time, not most of the time, actually lot of the time when ICT see bigger volume balance, he used that bigger one instead of the smaller one. That's why he most of the time set it off. And as you can see, this is the rejection block. If market can go higher above this volume balance, how far it can reach, that's why he has marked that rejection block. So keep that in your mind. This blue line is the rejection block. This line is the sell side imbalance, buy side inefficiency high. So these two lines, just keep that in your mind. I'm going to make it set off, and I'm now going to 1 minute chart. And let me go here where the price is actually around that. Just a second, let me actually keep it here. This is today's price action, so I would love to talk about here. ICT was bullish, so he told that if there is nothing happen in Middle East, that means that is unexpected, he will start to look for buy. There was a consequential crosspoint from the daily chart, daily week. I just didn't mark it because market never went higher. But his expectation was if market can go through that week 50%, then he will try to take buy by using that week 50% as a support. As market didn't go over there, I am just not going to talk about that week and about the buying setup. Instead, I would love to talk about this whole price action. This is today's new day opening gap. That means 4:59 close and 6 p.m. open. There is a daily gap. So this is that new day opening gap. Over here, as you can see, this is that rejection block. When market went above this volume imbalance, it went higher, trade that rejection block, then it went lower. In this whole area, all you need the regular trading hour. If you go to your ETH and over there electronic trading hour and the regular trading hour, if you select the regular trading hour, you'll see this is the gap which is called the opening gap. So previous day's finished business, you will mark a box from there. So let me mark it from there to today's 9:30 open. This is the gap which is called the opening gap. This gap is very important, and over here you have the opening gap range. What is the range? From 9:30 to 10, the highest high and the lowest low is going to be your opening gap range high and the low. As you can see, this is the 9:51 after, just before 10. So this is the 10 candle. Before 10, this was the low of that opening range gap. I would love to keep that opening range gap high only because the low has taken already. So I will just keep that one over there. That is the opening gap range high. I just didn't mark the opening gap range low. Now, as you can see by episode 13, where ICT explained how you should expect the opening range gap is going to work. That means when market closed over there yesterday it has closed over there, and today it has opened over here. Okay, so this is the gap. When market opened higher, you should simply think that market is going to trade the 50% of that opening gap. If you can watch this thing lot of times, maybe month after month, then you will build an confidence and you will be able to catch a run from the opening to until the 50% of that gap. Either way, this is a setup. But for taking this setup, you have to build the confidence by watching this thing again and again. This is a setup. This is a model that when you will see the opening gap, either market will close higher or it will close lower. If it close lower, if it open lower, you will expect that market is going to trade the 50%. If it opened higher, then you will expect that market will trade at least the 50%. So this is either way just a simple model to trade. For this, taking this trade, you have to build your confidence by watching this market again and again. Most of the time, ICT actually mentioned that 70% of the time this concept works. So keep that in your mind. So over here, as you can see, market trade until the 50%, then it went higher above this opening gap. When it has went over there, take that high and trade that, the rejection block from the daily chart. How market came over there? Tapped the old volume balance. See this volume balance high, it has tapped over there. At the same time, the 50% of the opening gap. After trading that area, market went higher and trade that rejection block. Now, after 9:30, the first parallel gap, you should keep that in your mind, because that gap is going to be retraded again and again. Either, the both way. That means whenever it will come to this gap, it can use that gap as a support, or if it can go through that gap which is going to be created after 9:30. Okay, so if you see from 9:30 to until that area, this is the gap which has created for the first time after 9:30. When market will go through this gap, it can use that gap as a resistance. Okay, so I'm just mark that gap. So when market came here, trading the old opening volume imbalance, daily volume imbalance high, as the same time the 50% of that opening gap went to this rejection block, then went through this gap. What should you expect? If market can go below that low, then market is going to take the whole opening range gap. It is going to take whole opening range gap. At the same time, how should you think market is going over there? Slowly, or it is going to tap over there and then boom, something like that. It will reverse and it will go higher. Or you will think that market is going to fall with speed. Obviously, ICT think that if market can go below that low one more time after trading the opening gap, went the 50% opening gap, then went higher above this opening gap, trade some kind of higher PDRA, for example this rejection block, then go back again below that low, it is going through all of this opening gap with speed. So keep that in your mind, this information. If you see this type of situation, you should observe, or you should journal, you should take the screenshot. Is it actually working most of the time or not? And as you can see, it went over there with speed. Okay, there was the speed, boom. How it went over there? Where is your entry opportunity? That fair value gap has created after 9:30. This is going to work as an inversion fair value gap. Now, if market would love to use that gap as an inversion fair value gap, how should you think that it is going to use that gap? You should think that this gap is going to be unfilled. As you can see above that high, so let me actually mark another line over there. So from there to there, and let me change the color. Okay, so from that yellow line to that black line, see this small portion is open. That is the sign that market is actually reaching for this whole gap is going to be closed from there. Why? Because market is weak over here. It's weak, it's not strong, because it failed to even close this inversion fair value gap which is created after 9:30. Again, it failed to close this gap perfectly. That means it's weak. How it is going over there with speed? Because it's too heavy. Okay, so you will look for this type of situation where you are looking for some kind of sell setup, and you will see that can market keep some portion open of some kind of specific fair value gap or not. If you see it can keep that open, perfect. You should be very confident that market is actually going to your target. Now, at the same time, if you take your entry over here, when it tapped the low of this inversion fair value gap, you should push your button over there. Where should be your target? Stop loss. Look at this week. Your stop loss should be above that week 50%. Okay, that means if you get stopped out over there, market can go above that week 50%. Then you will use this gap as a support. Market will trade that support as trade that fair value gap as a support. Then it will go higher, and it will take that initial buy side liquidity or the opening gap range high. Okay, not opening gap high, opening gap range high, and then maybe it will go keep going higher if your higher time frame is bullish, or if you think that market is actually reaching for any kind of higher time frame. PTR. At the same time, ICT also mentioned that first market fall, retrace. 1. Okay, so let me actually show you. 1, 2, 3. That is three drives pattern. Market has taken the sell side liquidity 3 times until that area. In that type of situation, you should start to think that maybe market is going to give you a retracement. That retracement can be deeper retracement, that can be the reversal as well. Okay, so it doesn't need to go do that, but you should think like that way. Three drive pattern. If market can take the sell side liquidity 3 times with 3 leg. Okay, so first leg retracement, second leg retracement, third leg retracement. 3 drive pattern, market has taken the liquidity. You should start to think that market can give you the deeper retracement or the reversal. It doesn't need to happen every time, but you should think like that way. At the same time, I would love to explain the price action over here, how it has traded around that area. First, market went through this today's new day opening gap, which is our inefficiency. So from this 2024 mentorship, ICT is focusing on new day opening gap or new week opening gap or this type of inefficient area. Okay, market ICT is actually focusing over there. At the same time, this yellow box, that is the volume imbalance. Please mark the quadral level over there and you will see how beautifully it has traded that quadral level. So let me actually mark that quadral level because it is also important. So over here to here, this is the quadral level. Okay, so when market fall and until came to the low of this volume imbalance below this new day opening gap, what do you see? This low and that low, they are relatively equal lows. Market started to go higher, take that buy side liquidity. The swing high, it has taken that buy side liquidity. What should you think? That market is going to reverse from this new day opening gap? When you see that market actually breach that new day opening gap, that means new day opening gap is not working. No, you are wrong. Market can go through this new day opening gap or new week opening gap lots of time, but it will keep using that new day opening gap as a reference. Why market went through this new day opening gap? Because you have seen that there is an imbalance. See, sell side imbalance, buy side inefficiency. Market actually went higher to trade that specific imbalance. At the same time, upper quadrant of this volume imbalance. So market trade that area, then market fall, trade this parallel gap, new day opening gap one more time. Now look here, market is using the new day opening gap now after trading the certain area over there, imbalance, upper quadrant. Now market is using this new day opening gap as its reference point. Trade that on, boom, market went lower. What it has done? Took all of this clean relatively equal lows. This all relatively equal lows has taken. Now you can think that what else is important when it came here to that upper quadrant or this parallel gap, that you can push your button over there to take sell. But where is going to be your target? See this imbalance, that should be your target. Why? Because this is the first imbalance where market can refer, then it can reverse again. It can do that type of things. So this parallel gap is also important. If you just mark that parallel gap and extend it to your right, you will see the precision over there. It went lower, take this relatively equal lows. Remember this high, this is the daily sell side imbalance, buy side inefficiency high. That is that line I showed you from the daily chart. Just 3 things I showed you from the daily chart. First, that rejection block. Second, this volume imbalance. Third, that sell side imbalance, buy side inefficiency. It came until that area, failed to trade here, and then went back until a certain level. Where did it came? To that specific parallel gap that has created over there to make the trader think that okay, this parallel gap is going to hold the price, send it back higher. So this is the trap parallel gap which is now going to be reused. Okay, as you can see, market trade that parallel gap, constant constant perfectly went lower. Where did it came? Exactly to the old new day opening gap. When it came here to this new day opening gap, look over here, this low and that low, they are smooth lows. Okay, relatively equal lows. Market started to go higher. How far it can go? Above some kind of swing high or relatively equal highs, and also the 50% of that volume imbalance. See this volume imbalance, it has traded exactly the 50% of that volume balance. At the same time, this inversion parallel gap over there and this whole volume, and here you have this sell side liquidity. When it trade that area, boom, market went lower, trade this relatively equal lows that has been taken over there, and then market started to fall. ICT was talking about the launch macro, that where he actually expected that market will actually go higher and take some kind of swing high. That was his launch macro, but market didn't do that. Instead, market keep falling. That is different type of matter. ICT didn't explain these things. I have done this explanation in my life. So if you were with me in my life, you have already known what I was looking for over there, how I actually took sell or everything. You will see over there, but ICT actually didn't do explain anything after that on. So I would love to complete this part over here. So what you have learned from here, when the opening gap has created and then market has traded until the constant cost point of that opening gap went higher above the opening gap and trade some kind of higher time frame PDRA, then you should expect two type of things. Can it go below that low which has traded before and then went higher? Can it go below that low? If it can go below that low, how far it can reach until the low of that volume, that opening gap? It can reach until that. If it would love to go over there, how it is going over there? Obviously with speed. Now, if you would love to take a sell over there, how you are going to take that sell? With the first parallel gap after 930, if it can use as a reference point, then you can take this, entry from there until this area. How you are going to treat that parallel gap, that this parallel gap is going to be open. Okay, it's not going to be closed perfectly. It should not be closed perfectly over there. It should show you some weakness that market is heavy, so it is actually going to fall. If it can close perfectly that volume imbalance, this area, if it can close perfectly over there, it can go back again from where it exactly went higher over there to the low, tick by tick to the volume balance low. From there, it went until this upper quadrant, went through this new day opening gap one more time, used this new day opening gap as a reference point. Boom, market went lower, take that smooth lows. Come here, trade that inversion parallel gap one more time, went lower, made another sell side liquidity, trade that inversion parallel gap one more time, took all the buy side liquidity. Boom, it has taken that sell side liquidity again. So that was the theme point over here. You have to journal, you have to watch this market again, and then you will build the confidence that okay, this thing is something that is going to work. So now I'm going to go to the price action over around that area. Okay, so I should actually uh, explain something around that area. I want to explain this thing right now. So this is actually the price action. You remember this is the sell side imbalance, buy side inefficiency, daily sell side imbalance, buy side inefficiency high. So around this time, 11 something, some kind of that time, market has traded that high, some specific reference point. Okay, so when market went through this volume imbalance from daily volume imbalance, this is the opening gap. So let me actually remove the opening gap, otherwise you'll get confused. Let me remove that opening gap. I don't need that anymore. So it actually went through this volume imbalance, trade the sell side imbalance, buy side inefficiency. So it is using that fair value gap, daily bearish fair value gap as a inversion fair value gap. So this is the high of that daily bearish fair value gap. Now it is using that daily bearish fair value gap as a inversion fair value gap. Guys, I'm talking through first because I don't want to make this video so long. So I would love to complete it as soon as I can. When it tapped over there, you will simply look over here, this high and that high. What are they? Relatively equal highs. How beautifully that relatively equal highs are over there. Okay, around that area, market went higher, come back lower, went higher again, then fall again, then boom, market went higher. Look at this specific candle. ICT has told that if you use some kind of reference point for the London kill zone, what is the London kill zone? 2 a.m. to 4 a.m. That is the London kill zone. Though I have learned it by watching ICT's today's video, I knew that the London kill zone is 2 a.m. to 5 a.m. But today ICT told that it's 2 a.m. to 4 a.m. It can be slip of tongue. Uh, I suggest that keep that in your mind that kill zone is 2 a.m. to 5 a.m. Okay, so it can be the slip of tongue of ICT. So I will keep talking about 2 a.m. to 5 a.m. instead of 2 to 4. Okay. So this gap which is going to create after 12, so from 12 to 12:30, that is the opening gap. In that specific time frame, when you will find out some kind of fair value gap that you are going to use as a reference point for the London kill zone. So look at this fair value gap. Okay, this fair value gap has created around 12:30 on. Go to your chart, or you can see bottom here, that fair value gap has created around 12:31, just 1 minute past 12:30. So around the opening gap, you are going to use that opening gap, 12 to 12:30 gap, for the London session. All you can see that market has traded that gap, then it went higher. Okay, when it has traded that gap, 201, time is the main factor over here. So market has traded that gap around 201. Perfectly trade that opening gap, fair value gap, that you are going to use for the London session kill zone range. If you see, there is another fair value gap which has created around 2. So this is that gap. Let me mark it, and I'm going to extend it to my right. Okay, so here, this is the candle which has traded that gap again. So the gap has created around 2 a.m. This gap is going to be traded over here. Maybe you won't be able to mark that gap. No worries. Look over here. Low, high, lower low. What is that? The breaker block. And all you can see, market has traded that breaker block over there. Okay. Perfectly, it has traded that breaker block, reached until this fair value gap. Time is the factor. When 350 to 410 macro. This candle has created around 409. That means it is inside the macro, 350 to 410 macro. It has traded this macro, that fair value gap, or the breaker block. Then it went higher, where it is reaching for. Remember this buy side liquidity, this relatively equal highs over there. It has taken that relatively equal highs to from there. Okay, so you are going to learn what you are going to learn from here, from 12 to 12:30, which is going to be your opening gap for London session kill zone. London session kill zone, which is actually 2 a.m. to 5 a.m. Okay, I will keep it 5 a.m. Around that opening gap, the obvious fair value gap, which is going to be used as a reference point for the London kill zone. And if you see around the London kill zone, market has traded that type of fair value gap or something like that, and you have the bias or the buy side liquidity, or the liquidity, okay, above the market or below the market. If you are bullish, then obviously above the market. If you are bearish, then obviously below the market. If you have the liquidity, you will start to use that reference point which has created around 12 to 12:30. So you will see the time. If the time is aligned with your concept, then you are going to use this one. You are going to use this concept. You are going to do the journal over here for building more confidence to go for that. I hope that it is also clear. I wanted to give you the summary of this specific area, why you should use that type of gap or breaker block, or this gap, why this gap is important, when this gap is important, why this breaker block is important, or breaker block or fair value gap is important, when it is important. If you can find this out, perfect. At the same time, you have to keep that in your mind, that how it is trading the quadrant level. Now you can see that it didn't actually trade that on. The reason is my quadrant level is not aligned with the price action perfectly. As you can see that it is little above. See, it is little above. If you just put it little lower, you will see that it has traded that upper quadrant over there. This upper quadrant has been traded perfectly. Actually, let me show you that. Otherwise, you'll get confused. Okay, so over here. Okay, so that is the quadrant level. I hope now it is absolutely perfect. And you can see it has traded that upper quadrant, came lower. From that upper quadrant, it came lower, trade that specific breaker block or fair value gap around the macro time, trading that on, then boom, market went ahead and took that specific buy side liquidity. That was your target inside this volume balance, and then market went through this volume balance, trade over there. I also love to talk about here that specific area where ICT talked about this price action. Okay, so in yesterday's ICT's what to say, I mean the execution video, some of you got confused why ICT took the buy over there, why he put the buy stop over there. That was the important part. I also tried to explain that on, and I'm happy to see that ICT's and my expectation was absolutely perfect. Now I actually explained the order block here, but ICT has used this nude opening gap. So let's use this nude opening gap the way ICT has explained. Okay, so here first market went through this nude opening gap, closed above this nude opening gap, and went higher, made this relatively equal highs. See this relatively equal highs. Then ICT was looking for how market can reach for this low. Okay, and he see that market failed to close below this nude opening gap. See, it closed above this one, even it failed to take that low. It has failed to take that low, closed above that one. So he was going to use this fair value gap as his reference point to take buy. Why is he's not looking for sell? Because if he saw that market closed below this new day opening gap one more time, or market went below this low, then he will start to look for sell, maybe for some kind of relatively equal lows around that area. This low and that low, they are relatively equal lows. ICT would look for that relatively equal lows to take sell. When he has seen that this new opening gap hold the price over there. Okay, here first time it went lower. If it can go below that low, that means this new opening gap has broken. But this new opening gap is holding the price even the week failed to take that low. So it gives him the confidence that no, market is not going lower. Instead, it is going higher. From where? Relatively equal highs and the specific volume imbalance. Remember that was open over there until that area, that specific area was open. If you remember or not, I don't know. But there was a specific area that was open. Actually, let me show you that open area. Okay, that was the open area. So this gap was open over there. Let me change the color. Okay, yeah, this specific area in this volume imbalance was open. So ICT's expectation was if market can close below this gap, new day opening gap, then ICT will start to look for sell. But if when he saw that market failed to close this one, even go below this one, he started to look for buy. And when he saw that market is actually jagging it, okay, it's not like showing the something boom, then tap to this one, boom, something not like that way. So what he has done, he put the buy stop. He put the buy stop and flipped that candle low, that market is not going below that low. And as you can see, market perfectly went higher, trade that volume balance where ICT actually closed his trade. Then he was busy to upload that execution, so he missed this sell. Okay, he has just missed that sell. Then market went lower, came until this area. Then there was a buy setup. Now both of me and Tanja, ICT was in Tanja's live, so he told that he was this is a little risky buy. And when he was watching Tanja's live, Tanja he was praying that Tanja is not going to hold the trade for so long, because ICT was framing a sell setup over there. Okay, ICT was willing to take a sell over there, so he was thinking that please close the trade as soon as possible. Okay, now over here, as you can see, the buy setup I'm not going to explain because ICT didn't explain that one. All you can see, market has traded this volume imbalance. See this volume imbalance, and market has failed to trade the lower control. Okay, so this is the control level. Market has failed to trade that lower quadrant. That means market is too weak to go higher. So it is not going higher, it is actually going to fall. When it is going to fall, he was referring the order block. So over here, see these two consecutive candle, they are going to be the order block. When market close below this specific opening price, the algorithm is referring that point as the entry point or the order block level change in state of delivery. So ICT actually pushed his button when he saw this order block. Then he added over here because market closed below this new opening gap. See this new opening gap, it closed below this new opening gap. Tap to this new opening gap, he actually pushed his button. Why he pushed his button? Look, this low has taken that low. Remember the same area here, that the same situation over there. Here market closed this new opening gap, and here market failed to close that new opening gap. But this time market closed below this new opening gap, also took that low where this area, market failed to take that low, but here market has taken that low. So he pushed his button over sorry, his button over there, and his trade actually closed around that area, below this relatively equal lows, or relatively equal lows around that area. There was a lot of relatively equal lows. He closed his trade around that area, so that was his sell. Okay, so guys, that was the video. I don't know how long this video is. I tried to make it as small as possible. If you think you have some doubt, don't let me know to the comment box, and if you think it is insightful for you, don't forget to give me the thumbs up. Don't forget to subscribe to my channel. So until the next video, cheers.